If you're thinking about buying a condo, this video is for you. Condos can be a great option, often more affordable than single family homes and located in areas where detached homes may be out of reach. But condos come with slightly different lending rules and homeowners association obligations that you absolutely need to understand before you go under contract. In this video, we're going to cover how condo financing actually works, the differences between financing a condo versus a single family home, HOA requirements and red flags, what lenders and underwriters care about, and what you, as a buyer, should be paying attention to. From a lending standpoint, a condo means you own the interior of your unit, you share ownership of the common elements, roof, exterior walls, hallways, elevators, amenities, and land, and those shared elements are managed by a homeowners association, or HOA for short. Because the HOA plays such a large role in the property's condition and finances, lenders underwrite the HOA almost as much as they underwrite you. That's the biggest difference between buying a condo and buying a single-family home. Condos can be financed with conventional loans, FHA loans, VA loans, USDA loans, though uncommon but possible in eligible areas, and alternative doc loans. However, not every condo qualifies for every type of loan, even if you qualify as a borrower. Conventional financing is the most flexible and common option for condos. Some key points are minimum down payment can be as low as 3% for first-time home buyers, 5% down is required for repeat buyers. Condos can be primary residences, second homes, or even investment properties. And mortgage insurance applies if you put less than 20% down. Conventional loans do not require the condo project to be on formal approval list like FHA, but the HOA still has to meet eligibility guidelines. FHA loans do not automatically work for condos. For FHA financing, the entire condo project must be an FHA approved status or qualify under spot approval rules. Common FHA condo issues are too many rentals, investor concentration too high, HOA budget problems, ongoing litigation, and the legal formation documentation for the HOA. Because of this, some condos simply do not qualify for FHA, even though buyers assume they will. We always want to do our best to vet FHA eligibility before writing an offer when possible. VA loans can be used for condos, but the condo project must be VA approved. Approval is often easier than FHA, but still required and issued directly by the VA. And in some cases, even if the VA will not approve the HOA, the veteran can still buy the condo using a VA loan. The benefits of VA financing are 0% down payment, no mortgage insurance, and typically lower interest rates. VA condo approvals can be added relatively quickly in some cases, but timing matters, especially in competitive markets. Every condo has HOA dues. These fees typically cover things like exterior maintenance, roof and structure, insurance for common areas, landscaping, amenities, and sometimes water, sewer, trash, or gas. From a lender's standpoint, HOA dues are treated like debt. They directly affect your debt-to-income ratio. The high dues can limit affordability even if the price seems low. As a buyer, you should ask, what exactly do the dues cover? Are utilities included? How often do dues increase? And are there any special assessments right now? Lenders will review the HOA's financials, including the budget, reserve funding, delinquencies, pending litigation, and insurance coverages. Key underwriting thresholds at a high level are as follows. No more than 15% of owners may be over 60 days delinquent on HOA dues. No active litigation that threatens the project, and adequate master insurance coverage. If the HOA fails these tests, financing might be limited. Only certain loan types may work, and some buyers may not qualify at all. This is why some condos may sit on the market longer, not because they're bad units, but because the HOA is poorly managed, or there is significant ongoing maintenance. In some cases, it may simply be an issue with the percentage of commercial space that occupies the building. A special assessment is an extra charge owners must pay when the HOA doesn't have enough money in reserves to cover a major expense. These things could be roof replacements, structural repairs, elevator work, and any other deferred maintenance. These can be one-time lump sums or monthly payments over years. Lenders may count the assessment as part of your monthly debt, require proof it's been paid, or decline the loan altogether if the situation looked risky. Always review. current assessments, planned assessments, and recent engineering or reserve studies. When it comes to insuring a condo, the HOA insures the exterior and common areas of the building. You, the borrower, insure the interior of the unit, known as walls-in coverage. This is typically a specific type of insurance policy known as an HO6 policy. They cover interior finishes, personal property, liability, and loss of assessment coverage. HO6 insurance is usually cheaper than single-family homeowners insurance, but it's still required. Beyond the financing, remember, you are agreeing to rules and restrictions. HOAs regulate rentals, pets, noise, renovations, and use of common areas. Make sure you read and understand the bylaws, rules and regulations, and rental caps and any other restrictions. A condo can be a great lifestyle fit or a frustrating one, depending on your expectations. Condos can be used as investment properties, but down payment requirements are higher, requiring a minimum of 15% down. HOA rules may limit the amount of rentals that can be in the building, and short-term rentals may be prohibited altogether. Always confirm rental rules before buying with an investment intent. Buying a condo isn't just about the unit, it's about the HOA, the finances behind the scenes, the loan program you're using, and the long-term rules you're agreeing to live under. If you're considering a condo purchase, getting pre-approved early and getting some initial information about the HOA upfront can save you a lot of time, money, and headache. If you found this video helpful, please subscribe and follow us on social media for more straightforward mortgage education.